Hello everybody and welcome to BetaShares educational webinar. Today our topic will be hybrids, risks, pitfalls and opportunities. As always, before we get started, just to let you know that the information we're presenting here is indeed general in nature. It does not, should not be considered as personal advice. If you have any interest in any of the funds we mentioned and indeed the hybrid fund, please do refer to our website and refer to the product disclosure statement. As well as that, a little bit of housekeeping as well before we get started. Everybody who has registered for this session will be sent a recording, including the slides that we go through. And if you have any questions to ask, please do use the widget where you'll be able to type in questions there. And we will try and respond to as many of those as we can before the end of the session itself. Today we will be talking about hybrids, and I'm joined by somebody who may likely be familiar to many of you, our Chief Economist, David Bassanese. David is the author of the Australian ETF Guide and has been a prominent economist for a number of years now, had previously been working at the AFR, where he was a columnist there for approximately a decade, and had been an economist at places like Macquarie Bank, OECD, and the Treasury. He is joined by Peter Harper, our Director of Distribution and Head of Capital Markets. Peter was formerly with Macquarie Bank and had also been at ABN AMRO and UBS. Today, what we'll be talking about is hybrids. So first of all, a quick recap on what hybrids are and how they fit into portfolios from a risk-return perspective. We'll talk about something we've been hearing a lot from clients, which is the challenges of directly investing in hybrids. And then we'll point to our newest launched fund, the BetaShares Australian Hybrids Fund, or HBRD, which has been developed to help people cope with some of the challenges of investing directly in hybrids. So without any further ado, I will pass over to David, who will talk a little bit about the hybrid industry. After you, David.
Thanks very much, Alan, and thank you everybody for joining us today. I think it's a pretty exciting development here as we move into the sort of income area with our hybrids fund. But firstly, some information in terms of, so I know many of you maybe already invest in hybrids or may be interested in investing in them. So just some background information. So firstly, where do they sit? So just in this first chart, essentially hybrids, they're basically, obviously the lowest risk, lowest return asset class is cash. And at the other end of the spectrum, the higher return, higher risk in terms of volatility and whatnot is shares. Fixed income, traditional bonds, somewhat, more riskier than cash, not as risky as shares. And hybrids basically sit in between. So as we sort of shown there in the diagram, and as I'll go through, they basically offer income returns or returns generally somewhat higher than traditional bond investments, fixed income investments. Not as much as shares, but at the same token, a somewhat higher volatility than bonds, but not as much as shares. So they do play a legitimate, and I guess one of the points here, and again, I'm not here to necessarily praise or criticise hybrids. They've got their share of attention over the years, but it's not fair to say that well, basically, they have a legitimate role along the risk-return spectrum, as we'll go through. They have elements of both. And so if you go to the next slide, we look at what are hybrids. So basically, when you think about it, to some extent they have debt characteristics. So that in terms of the capital structure, they do rank ahead of equity in the capital structure. What that means that if a company that has issued a hybrid and has issued equity in general were to, become insolvent, hybrid holders would get their money back ahead of equity holders, not as quickly as say bond holders would get them back, but nonetheless ahead of equity holders. But the special case for that is in the case of banks and some hybrids, as I'll talk about in a minute. They do generally also pay regular interest payments. Debt characteristics. So debt characteristics, they rank ahead of equity. They do pay a regular income, and generally they have a fixed, or debt have a fixed maturity date. Equity instruments are more perpetual, so there's no fixed maturity for equities. They're subordinate to capital, to bonds in the capital structure, and can be written off in times of distress. So hybrids are a little bit of all of these things. And that's the challenge, is to know for any given specific hybrid, do they have more debt characteristics in which make them relatively lower risk, or do they have more equity type characteristics? And the issue is that a lot of hybrids out there, you've got to really read through the terms and conditions of all those specific securities to understand the actual underlying risk characteristics of each security, and that is the challenge. Just to go through, again, to reiterate where they kind of sit in that capital structure. So I guess the highest risk exposure there is is equities, so shareholders in the event of a company defaulting. Thereafter are hybrids, and then the various levels of debt. So in this case, we're looking at, say, a bank, for example. If a bank would become insolvent, obviously the equity holders would be written off. Hybrids would then next be, and again, the issue with banks, in the case of Australia in particular, like a lot of the hybrids, as we know, they have these bail-in provisions. So if a bank, CBA, NAB, heaven forbid, were to become insolvent, it's likely that the hybrid holders would be exposed as well, and that they would be bailed in, and that either their hybrids will either be converted into equity or potentially, written down to the value of zero in line with equity. So that is the clear risk in cases of insolvency, as distinct from, say, term deposits or at a bank that are relatively, should emerge relatively unscathed, certainly if they have insurance behind them. But as I said, barring all that, the probability of a bank in Australia going broke, you could argue, is pretty low. And then hybrids have certain other features, as I'll get on into in a minute, that make them still somewhat less risky than equities in terms of volatility. So secondly, so the next slide is why have hybrids been issued in Australia? The market, there's about 50 billion of hybrids in existence in Australia. So 50 billion in ownerships. They've been issued largely by many of our banks, and essentially regulatory requirements. So that under the new capital guidelines, banks have been required to hold more capital. Issuing hybrids has been an attractive form of issuing that capital. And partly because of that bail-in provision, if banks were to get in trouble, these hybrids can be converted into equity and act as an equity buffer for the banks. They've also been attractive because they do attach the franking credits. So the banks can issue these, and you get the tax advantages through franking for investors. They're given their yields, or the yield returns, as we'll see on hybrids, are certainly higher than in cash and more traditional bond investments. They have been attractive for investors in our low yield environment. So they've been obviously popular for their yield and popular, so from a buyer's perspective and from an issuer's perspective, popular because they are treated as capital under the new capital provisions. So that's why we've had a big issuance of them. So where do they sit? So this is not just looking at risk and return. So firstly, the return. So again, like one unfair criticism of hybrids you may have heard is hybrids give you equity risk for bond return, and that's basically unfair on both counts. So firstly, if you look at the return, so as of 31 October. The running yield on a collection of hybrids that, for example, that would form part of our hybrid fund was offering a yield of around about 5.3%, including franking credits. So that's about double what you would get from a term deposit, 1 or 3 year term deposits being offered by banks, and well up on even what you would get if you were interested in, like, for example, our high interest cash ETF. AAA offering about a 2% yield. So 5.3%, certainly well above what you could get from traditional bonds and term deposits. In fact, close to the the income return you get from the ASX. The ASX grossed up yield, dividend yield, is about 5.7% as at end October. But in terms of equity, obviously it's still somewhat less than what you get from banks. So if you look at the ETF there, we have a financials ETF that gives you exposure to financials, a big chunk of which are banks, and the grossed up yield was running at around about 7%. So, obviously if you invest in bank shares, you'll get a higher grossed up dividend, somewhat higher, and potential capital growth with those shares as well. So so the income return, not as much as you would get from equity, but certainly better than you would get from bonds. Now, the quid pro quo of all that is that they are generally less volatile and less risky, as you'll see in the next slide. So what I've got there, this is the drawdown, so-called drawdown curve. So this is the peak to trough decline in prices for various investments there over the past few years, certainly since the GFC. So you can see that during the GFC, when we had a major sell-off in the equity market, bank stocks at one point were down 50%. And for a brief moment in time, there was a conjecture that some banks may be vulnerable, potentially become insolvent. At that time, a collection of hybrids, so a hybrid portfolio of securities, did fall in value as well. They were off 25%. So that's a pretty chunky move, but certainly much less than what bank stocks sold off during that GFC event. And if you fast forward to the sell-off more recently, earlier last year, our bank stocks again sold off by around about 25%, which is part of a general equity market shakeout at the time. And the big difference from the GFC is that solvency, no one was really seriously questioning the solvency of banks at that moment. And as a result, hybrid values, as you can see from that black line, hardly moved. So the argument here is that in periods of normal equity market volatility, and certainly those in which bank solvency isn't at risk, hybrids generally offer much less downside volatility than what shares would do. So that is the risk-return trade-off. And so going back to that original slide. So that's why they sit there. You don't get quite the income that you get or the return from equities, but you don't get the downside risks generally either. In terms of issuance, as you can see from this slide, most of the issuance over the last few years has been dominated by the financials, the major banks in particular, and for the reasons I went into, in that they've been an important source of funding for banks to beef up their capital as required by the regulators. In terms of valuation, so are hybrids cheap or expensive? This chart just shows you the average yield on the tier 1 hybrids of the major banks over the bank bill swap rate, and you can see at the moment it's around about it's post GFC average. So you'd argue they're reasonable value here. They're not particularly super expensive as when that spread got down to around 2% in early 2010, and certainly not particularly super cheap when they blew out to around about 5% spread earlier last year during that sell-off. So at the moment they're reasonable value, and that gives you an idea of the sort of the yield pickup one can get on hybrids in general over the shorter term interest rates. So what about so again, just to reiterate, a legitimate role, the position along the risk-return spectrum, offering a reasonable income, a reasonable downside protection, though there are challenges in owning hybrids directly, and we'll just get into that now. So just with the first point, obviously first complexity. And again, the thing about hybrids is that the terms and conditions of these things are incredibly complicated. So, are they more equity? Are they more debt related? Depends on the particular hybrid in question. And so from a sense, we know what the returns on, or what the return is being offered from a hybrid. You know from the yield what it offers. But what the typical investors aren't too clear about is what is the risk. And that's where you're really going to peer into the actual terms and conditions of these hybrids. And that's where it's a challenge for, I guess the typical retail investor who doesn't have, the legal knowledge or the detailed knowledge to really understand the terms and conditions behind them. So that is a challenge. And I guess the implications, you may end up, the risk is if you don't really, given the complexity, you may end up buying a hybrid that has more risk than you would desire, or you're basically not getting properly compensated for the risk you're taking on in those hybrids. The other one is concentration risk. So typically, as it seems that people are only holding a handful of securities at most, 3 to 5 individual hybrids, which can give rise to concentration risk. You're potentially getting excessive exposure to 1 or 2 company names, whereas with a managed fund you can get greater diversification, as we'll get into. The other one is liquidity, and again, the turnover, the hybrids is a largely passively held type of investment. There's not a lot of trading that typically goes on. Turnover is low, and so bid-offer spreads, certainly bid-offer spreads, but if you're trying to trade in and out of hybrids with any degree of size, can be relatively wide, certainly for retail investors, and certainly wider than you typically see in the equity market, for example. And so, again, that suggests, you're leaving it to a professional fund manager to do that trading makes some sense. The other one is market risk, and that, again, with hybrids, depending on market conditions, if risks in the banking sector were to pick up, and they were, there was a potential risk of a hybrid selling off, the typical retail investor may not be as aware of those risks as say, a professional fund manager who potentially can reduce exposure to hybrids as required, and or by the same token get back into hybrids if maybe they've sold off a lot and they're looking quite cheap. So being able to manage that risk over time. So they are the challenges. And just to again dig into the details here, this is one of the aspects of hybrid. So all of these things here are hybrid securities, but the degree of risk of them really depends on these conditions. So, for example, at the one end of the spectrum, hybrids can be relatively closer to so-called subordinated debt, where basically, you're fairly well secure in terms of getting regular income payments. You kind of know when they will be called, so you know what the maturity of the bonds would be. But then you can get some that have conditions in them where they can, have an option to defer interest pretty easily. So you could be getting interest on this security, for a few years, and all of a sudden the issuer decides to either, temporarily halt income payments. And then there's also, they vary in terms of their degree of loss absorption. Should the bank or company get into financial difficulty, to what extent that particular hybrid is at risk of basically being converted into equity. So there's a lot of different features that are tied to hybrids, and to really understand all those different risks does require a level of expertise in reading through the various terms and conditions. The next slide is just to highlight the bid-offer again, and not the prettiest slide, but if you look at the blue line there, you can see that the light blue line is basically the CBA share price and the bid-offer spread on that share, and it shows that it's quite close to the the zero line there. Whereas for the typical hybrids issued by the CBA, the spreads can be quite a bit wider. So that's the idea that the hybrid market is not as liquid, doesn't trade as often as the equity market, and so investors will be subject to relatively wide bid-offer spreads accordingly. With that, I will now hand over to my colleague Peter, who's going to go through some other aspects of the hybrid market, and then tell you what our solution in view of these problems is.
Thanks very much, David, and thank you to everyone for making the time to join us today. We do genuinely appreciate it. I just want to start off looking at this slide here, and this looks at the spread, which is effectively the valuation of Crown HA and Crown HB notes in the market. Now, historically, the anecdotal feedback we've always had is that most people tend to be fairly set and forget in their hybrid positions. They tend to buy them at new issuance and then hold them until they roll over into another security. And look, funnily enough, that's probably worked all right for most investors, because we haven't had any issues of hybrids being forcibly converted into equity or anything like that in Australia, at least not yet. But I did want to point this chart out, because this chart looks at the spread over fair value, or effectively the spread that these two securities are trading at. And as you can see, there are times where the chart heads upwards, where the hybrids are becoming quite cheap. And when the chart is down towards the lower part of the gap, that's when the hybrid is quite expensive. So if you were to just buy one of these Crown notes on on new issuance and sit and leave it in your portfolio gathering the income, you're effectively ignoring the fact that the traded margin on that security floats around and moves around all the time. Now that has two important implications. The first is you could potentially be holding a security that has become quite overvalued and you wouldn't be doing anything about it. And that creates risk in your portfolio if you continue to hold something that has been overvalued or is currently overvalued. It can create a risk to potential capital downside. The other factor is when capital values move around this much, it creates active trading opportunities for a professional manager who can effectively value these securities. It gives them the opportunity to get out of securities that they deem to be overvalued and move into securities that they deem to be more attractively priced, and to thus generate potential outperformance relative to just a buy and hold hybrid strategy. Now, most retail investors cannot value these securities effectively and therefore do not have the means to know when they're cheap or when they're expensive. An active manager does, and therefore has the ability to either profit from that or at the very least make sure that they're not sitting permanently in overvalued securities and therefore avoid the risks to capital that could potentially come from such a position. So the solution we've come up with here is to look at the HBRD fund. As we've mentioned, it's an actively managed strategy, and we think that's very important in this space for the reasons I've just outlined. But I'm going to look at some of the other problems just at a higher level. So first of all, the hybrid market is a relatively inefficient market. And as many of you are probably aware, active managers, generally speaking, have strong track records of outperformance in areas where markets are inefficient. So examples could be small cap equities, or in this case, hybrid securities, where not many people have the ability to value those securities. It creates a lot of opportunity for those who can. So the fact that this is an inefficient market and is prone to regular over and undervaluation makes it a difficult market for a retail investor to hold, but that in itself creates opportunities for a professional active manager such as that running the mandate for the HBRD fund. Secondly, and I touched on it before, if the manager sees that securities are becoming overvalued, they have the ability to either move into more attractively priced securities or to move further up the capital structure to help mitigate risks to capital that may otherwise eventuate. If you just buy a hybrid and hold it passively, that is not the case for you. Thirdly, the issuance terms of hybrid securities are complex and they differ greatly from security to security. I would dare say that many investors out there do not fully comprehend the differences between the issuance terms of the plethora of hybrid securities available in the market. A professional manager knows those terms intimately and which terms apply to which securities, and therefore might know which securities are more likely to be converted into equity or not, and under what circumstances. So that can help mitigate some of the complexity or the risk that a direct investor would face. Hybrid security holdings tend to be fairly concentrated for most retail investors. They, again, anecdotally, and everyone's portfolio is different, but from what I hear around the market, most people tend to hold sort of 2 to 5 hybrid securities. That's a very a very concentrated portfolio. Not many people would own a portfolio of only 5 shares. So using a fund such as HBRD can add a lot of diversification to your hybrid portfolio, given that the fund will likely hold between 20 and 50 securities. And finally, the hybrid market on screen is a relatively illiquid market because most holders are fairly passive in nature. They tend to just buy and hold. And that means there's not a lot of trading that goes on in these securities, and liquidity can be sometimes problematic. A professional active manager, such as HBRD has appointed for this fund, has the ability to trade in both the crossings market for hybrid securities, which is a market that exists between large institutional players, and potentially the OTC hybrid market, so the OTC market for listed hybrid securities, which settles through a different system called Euroclear, and that's something that most people who buy and sell on the ASX would not have access to. So there's the potential there for an active manager to access better liquidity than a direct investor may be able to achieve themselves. So looking at the actual investment strategy, what are we targeting here? First of all, we're trying to target returns that are after fees greater than the Australian Hybrids Index. The Australian Hybrids Index we're referring to here is every hybrid security as defined by ASIC, market cap weighted. So we're trying to generate a return net of fee that exceeds that index. There's also an absolute return target, which is we're very interested in trying to preserve capital regardless of what happens in the hybrids market for investors. So the additional return target is RBA cash plus 2.5% over the medium term. We understand that many people hold hybrids for the income that they provide and the lower volatility than equities. And therefore, we have an objective to try and provide a franked running yield that is generally similar to that of the broad hybrids index, so that people aren't facing a drop in income from moving into the fund on a post-fee basis. We've also got target volatility of 3 to 4%, which is in line with the broader market. And we want to eliminate what's known as duration or interest rate risk by only holding floating rate exposure. Furthermore, and I mentioned it earlier, the fund has the ability to go to 100% cash or bonds if hybrids are materially overvalued. And most investors, as we've covered extensively, would not have the ability to know when a hybrid security is overvalued or not. So let's move on to the next slide now. So some of the basics on the fund, I've mentioned the ticker a number of times, HBRD. It is actively managed, not passively managed. And the all-in fees are 55 basis points of base fee and a performance fee capped at 15.5% of outperformance over the index. Now, I'll just mention that performance fee is subject to a high watermark and is net of fees. So, first of all, the manager must beat the index performance by more than the amount of their fees in order to be eligible for a performance fee. Secondly, the high watermark means that the fund must have had positive absolute returns in order for the performance fee to be valid. So you can't get paid a performance fee just because we outperformed in a falling market. i.e., you don't get paid a performance fee if you fall, but fall less than the market. It's only in circumstances where the investor has had a positive return and effectively there's no situation where the investor can be worse off as a result of that performance fee. It's also worth just touching on here that the current running yield for the fund is just over 5% gross, and that is in line with the yield on the broad hybrid market. In terms of the investment strategy, the fund's core holdings will generally be in ASX hybrids, probably about 80% of the portfolio generally sitting in hybrids, and that will be augmented by cash, subordinated debt, and senior notes. We did mention that the fund has the ability to move up the capital structure out of hybrids and into cash if the manager deems there are risks to capital from overvalued securities or default risk on any of those securities. But obviously you need to hold a core in hybrids in order to try and maintain your yield objectives over time. In terms of the active manager for HBRD, BetaShares, after a competitive tender process, has appointed Coolabah Capital to run the institutional mandate for the HBRD fund. Coolabah is a specialist active credit manager with about $2 billion in funds under management and are one of Australia's largest fixed income boutique managers. As of November 2017, Coolabah were the best performing cash plus or short-term fixed interest portfolio manager over the past 6 years or so, according to Morningstar. So we believe we've appointed a very high quality manager to manage this portfolio. Coolabah also has rigorous quantitative and valuation capabilities that we believe most managers in this space, or many managers in this space, do not have, and that certainly retail investors and many advisors do not have access to. Just covering off further on the investment strategy, we've got the deliberate flexibility to move up and down the capital structure. So you can see hybrids sit above equity, so they're considered generally safer than equity, but below subordinated bonds, senior debt, cash and covered bonds. So if there are risks to the hybrid market from overvaluation or from risks to default, the manager can move up the capital structure to help protect your capital above all else. That is a flexibility that most people do not have in a set and forget hybrid portfolio held directly. And we think this is really important to protect capital over the long term. On the chart on the left here, the blue bars are the cash balances historically of one of Coolabah Capital's funds. And the grey bars are the proportion of the portfolio held in bonds and hybrids. What you can see there is that Coolabah has a clear track record of taking money off the table to preserve capital when hybrids or bonds look overvalued or at risk of potential default. Again, we emphasise we think this is a really valuable part of the strategy in terms of protecting capital over the long term through the cycle and in difficult market environments. Here we've got the performance of one of Coolabah's hybrid mandates that they run for an institutional super fund. And the black bars are the performance of Coolabah's portfolio of hybrids relative to a broad portfolio of hybrids from another provider in the market. And you can see there that the Coolabah portfolio has outperformed over all time periods relative to the broad market hybrid portfolio. This chart's rather complex, so I'm not planning on going through it word by word. You can read through it in your own time, but essentially it talks about the quantitative and qualitative models that Coolabah use to select the hybrid portfolio. I'm going to try and keep this pretty simple. Coolabah employ both top-down fundamental valuation models and bottom-up Merton or default models, default risk models to try and select the best hybrid securities. So when I talk about top-down fundamentals, Coolabah Capital analysed the time to maturity, the credit risk of all, for example, of all hybrid securities in the market, and then look for which hybrid securities are offering the most attractive valuation based on those sorts of inputs. So they're always looking for those securities that are offering the best relative value in the market. That is the top-down valuation process. The bottom-up valuation process looks at the default risk of each security. For example, and I'm not suggesting this would happen, but what is the risk of National Australia Bank, to pick one out of the air, getting into trouble and its hybrid holders being converted into equity? If that were to happen, would the equity still exist, or would it be wiped out completely immediately, which is what happened in the case of a Spanish bank earlier this year? If it was wiped out, would there be any recovery for equity holders? These are all the sorts of bottom-up default risk calculations and models that Coolabah run as well to try and value securities and mitigate risks to capital. So finally, just to recap on why we think HBRD fills a really valuable space in portfolios. First of all, we think the hybrid space is a relatively inefficient space and therefore provides excellent opportunities to active managers with high quality valuation models that most other participants don't have. That hopefully helps them generate outperformance over the broad market. From a risk management perspective, we think an actively managed portfolio is very important in this space. It helps mitigate risks to capital arising from exposure to overvalued securities. It helps mitigate risks to capital as a result of issuance term and complexity of those terms. It helps mitigate risk to capital from default, thanks to some of the detailed default modelling that the active manager undertakes. And it helps mitigate risk to capital from a concentrated direct hybrid portfolio by diversifying into a more broad portfolio of circa 20 to 50 securities. I think currently off the top of my head we're holding 36 securities. Finally, we think the active manager has the ability to potentially access better liquidity than many investors may see in just the bid and offers of hybrid securities on the ASX. Some things to keep in mind, obviously investment risk, investment returns are uncertain and will be influenced by the performance of the market as a whole or other risks. Income payments are variable. And when interest rates fall, hybrids income payments can be expected to fall and vice versa, of course. Hybrids are by their nature predominantly issued by banks, creating sector concentration risk. HBRD is exposed to the credit risk of issuers. Hybrids do rank behind all other debt and deposit holders in the event of issuer default, but do rank above equity holders. The issuance terms of the securities are complex and can differ greatly from security to security, as we've discussed, and investors should seek professional financial advice before investing. Finally, we would always recommend investors read the PDS for more information about risks.
Great. Well, thank you so much, Peter. Thank you, David. We'll just have time for a couple of questions. As you can see on the slide there, we do have a wealth of information on our website, including obviously information about the HBRD fund. And we've also got a number of publications we put out every week, including David's Bassanese Bites Macro Insights. But I'll just have time to ask a couple of questions for both of the presenters today. One question here from Charles is, for you, Peter, does the BetaShares HBRD product pay franking credits, and to what level?
Okay. So the franking credits generated by the fund as a result of the securities it holds are passed through in full to the end investors. So I quoted that gross yield of a bit over 5%. That includes the franking credits, and that is in line with the yield of the broad hybrid market in Australia, which is one of the objectives of the fund. In terms of the percentage franking level, look, that will vary from time to time. I'm somewhat reluctant to quote it because I'm not exactly sure right this second based on the securities we hold, but it has been generally in that range of sort of 80 to 85% franked since issuance, and I feel fairly confident that we're in that range still.
Fantastic. So another one from you, Peter, if you wouldn't mind. Are hybrids in the ETF floating rate?
Yes, is the answer to that, and it is mandated as such that they must be floating rate. As you may be aware, bonds and fixed rate securities may fall in value if interest rates rise into the future, and vice versa. For that reason, we have made sure that the fund only holds floating rate exposure to make sure that there are no risks to capital should interest rates rise in Australia, which they are expected to over the next few years.
Fantastic. A question here for you, David, is related to one of your slides. What is trading margin?
That's basically the yield pickup. So the hybrids, Peter quoted a yield of like 5.3%. That's basically just the margin. So the difference between that yield and the yield on, say, bank bill swap rate, or the short-term interest rate in Australia. So that's basically what it is. So it's a measure of relative value. So when that spread is wide relative to short-term interest rates, it suggests hybrids are relatively good value, and when the spread is pretty tight, the more expensive. So it's a way of just getting a sense of is the overall hybrids market, cheap or expensive.
Okay, and this is probably worth answering. Just given there's probably a few investors on this call that may be new to ETFs in general. So there's a question that asks, how is do we buy the HBRD fund directly from BetaShares? I'll maybe ask Peter to answer that one.
Sure. All ETFs are traded on the Australian Securities Exchange, the ASX. So if you want to buy or sell an ETF, you would do so in the same way you would buy or sell a share through any stockbroker. So you would just go to your broker, be they an online broker or a full service broker, and quote the stock code, which is HBRD, and you would be able to see the market price and bid offer volumes, and you would buy or sell that security in the same way you would buy or sell any ordinary share.
And I guess one last question maybe here is, when is the first distribution? So I'll answer that question. It's a monthly paying fund, so the distributions will get paid every month. So the first full month will be coming up very shortly. So that's when the first distribution will be paid. So it is a monthly paying fund. Right, well, I think that answers all of the questions. Thank you so much, everyone, for your attendance. We will provide you some further information on this fund via email, and we look forward to your further interest in the hybrid fund in the future. Thank you all very much. Thank you, Peter. Thank you, David.
Thank you.
Thank you.